Welcome to the Smart Property Investment Show with your host, Phil Tarrant.
Good everyone, how you going? Thanks for joining us. Always a pleasure to have you with us on the Smart Property Investment Show. If you tune in a lot, you probably will notice that we get people back in the studio who have been on the podcast before and go away and do good things, bad things, indifferent things, sometimes some magical things, sometimes some not so. But we like to get them back on the show, get a bit of a recap, where they are, what they're doing, how they're going, whether they're still at property, whether their insights and mindsets have changed, and importantly, whether or not they're making any money. We're going to do one of them for this podcast show, and Michael Xia is back in the studio. He was last with us quite some time ago on the 10th of May 2016, so well over 2 years ago. It goes to show how long we've been doing the Smart Property Investment Show. At that time, the headline, and go and check it out, 10th of May 2016, even if you want to stop listening right now and you go and check in and listen to that before you listen to this one. 10th of May 2016, the headline was How Property Helped Me Quit the Rat Race. And I'll read out there's a short description here of what we said at the time. We said, Michael Xia is an investor with 14 properties in his portfolio, but initially he wasn't driven by a hefty retirement goal. He just wanted to quit the corporate job he hated and spend more time playing touch football. Now that he's ditched corporate life and he's waiting for surgery for a football injury, talks to Phil Tarrant, Smart Property Investment Show, etc., what the recent changes to the cash rate and bank interest rate actually mean for real life investors, and some of the financial tricks and traps all property buyers should know. All this and much more, Smart Property Investment Show. All right, Michael, how you going? Welcome back.
Really good. Good to be back here, Phil. Can't believe it's been 2 years since the last
what's happened,
show.
mate? You're looking as fresh and vibrant as always, you know.
No, I think I'm just enjoying the property investing and the mortgage broking industry, so it's been good.
What was this injury for a football surgery thing that you had?
It was actually an ACL.
Okay.
So I did my ACL really badly. It took me about a year to get back.
Really?
And I've been playing comps in the last 6 months. We actually had a grand final yesterday on Sunday and we lost that, so still pretty gutted over that.
Is this mixed touch footy or is
it is mixed touch footy,
Okay.
yeah. So yesterday's comp was at Artarmon, so shout out to the Artarmon crew.
They beat you? You're Artarmon?
Yeah.
Who beat you?
Oh, it was actually a mixed comp at Artarmon, so we lost the grand final yesterday.
Did you lose it for the team? Whose fault was it?
Oh, no, it was a team effort, but we lost in a drop-off. It was down to 3 drop-off and we lost 7-6, so it was really tight.
That's not good. What did you do afterwards? You go for beers and stuff and eat pizza?
For myself, I actually had a couple of client meetings for mortgage broking.
Did you?
Yeah.
That's cool. So you're back in business, you're running around, you're all okay, ACL's not too damaged?
Yeah, a lot better than before, but never quite the same.
So has this injury stopped you playing football for a little while, but has it stopped you buying property?
No, it's probably made me a bit more focused on property investing. Yeah.
Okay, all right. So 14 properties when we last spoke 2 years ago. So you've had 2 years. What have you done?
So since then, I'm up to 20 properties, and my 20th property actually settled last week. So it's actually really, really good timing.
That's pretty cool.
Yeah.
So what's the total value of your portfolio now?
It's just shy of 10 million. So at the moment, it's sitting at 9.7.
$9.7 million. And what sort of debt are you carrying on it?
A little bit over 6 mil.
So you nearly got $4 million in equity in your portfolio.
Yeah.
It's pretty good.
Yeah.
You happy about that?
Yeah, I mean, it's not too shabby. Considering like 5 years ago in 2013, I started with 2 properties. So it's been a good journey since then.
2013, so 5 years, yeah.
Yeah, 5 years.
Okay. So in 5 years, you've made yourself $4 million.
Yeah.
Not bad.
Yeah, I mean, not quite 4 million.
Yeah, but thereabouts. Yeah, I know. Blah, 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 blah.
Yeah.
Okay, I know, but a lot of people view it that way. So have you done it? Like, sounds pretty hard.
Yeah, I mean, it wasn't easy. Like, I won't say it's all beers and Skittles.
Yeah.
Along the way, definitely a lot of challenges. In terms of acquiring that portfolio, the majority of the recent purchases, and actually ever since kind of Sydney have moved up, have all been around the Brisbane-Logan area. And the recent 4 purchases that I bought have also been back there. So I think part of the success has been buying properties that look after themselves. That's how on the last show I originally quit work, because when I quit work, I had a little bit of a passive income, about 40,000 from the investment properties, gave me the courage to quit work. And then after that, focusing on the business for the last 2 years has also given me now the serviceability to pull out that equity, use that equity then to buy again. So a lot of it comes down to buying properties that look after themselves.
And so you're working as a mortgage broker now. Were you working as a mortgage broker when we last met? Or you
I had just started
doing
yeah.
Okay.
So I would have been about 6 months in at that time.
Okay. It seems like everyone, we'll chat before we come on air, who comes on a Smart Property Investment Show, either become a mortgage broker or a buyer's agent. I think it's people who have a passion for property want to turn it from being a hobby into something which is potentially, well, it should be a business anyway, but actually work within it, whether you're doing mortgage broking or being a buyer's agent. So how are you finding the broking side of
I
things?
love it.
Yeah.
And I mean, the reason why I became a mortgage broker was actually my mentor, my mortgage broker. And I know when I first started, I always wanted to get into more the investment field. I didn't like my day job, wanted to quit yesterday, but it was always tossing between what I would do.
Yeah.
And the two front runners was buyer's agent and also a mortgage broker. And the main reason why I picked mortgage broking was my mortgage broker, because he structured everything, did everything for me to help me go from 2 properties at that time in quick work at 14 properties. So after he did that for me, then I wanted to learn from him. And also part of the reason why last couple of years I've been on the Gold Coast. I've just been actually based out of his office.
Okay. So where are you from originally? Here?
Sydney.
Okay.
Sydney,
But
yeah.
you went up there and learn the craft, did you?
That's right, yeah.
Okay.
So I spent 2 years on the Gold Coast with Rolf Latham, sat in his office and just learnt the craft. And recently now, in the last 6 months, I've started to spend a little bit more time in Sydney.
Are you a good mortgage broker?
Well, last year I won the Mortgage Broker, MFAA Mortgage Broker of the Year for Young Mortgage Brokers.
So MFAA, that's the Industry Association
That's
for
right.
Mortgage Brokers.
Yeah.
Okay, that's all right.
Yeah.
They don't,
And
give
then
that,
picked up-
give that away easily.
No, and then picked up 2 other Young Mortgage Broking Awards too, apart from
Which
that.
ones are they? Which other ones you get?
So I got the Top Gun Top 30.
Okay.
And then there was I think it was the Advisor, or one of them, or was Young Mortgage Broker, or was a finalist, but I didn't take it out.
That's cool.
Yeah.
So what makes you a good mortgage broker?
I guess it's more so having the goal in mind. I feel that some mortgage brokers may look at it a little bit more transactional.
Yeah.
But something that I took from my mentor was more so being goal-based. In terms of investing in properties, bricks and mortar, the property itself is a vehicle. It's really to help you where you want to go. And I feel the difference in terms of how we work is actually finding out where people want to go and helping them to get there. So maybe the lending structure, say for instance, if someone wants to buy a home, pay it off, then their lending structure is going to be very different to someone who wants to build a portfolio of 10 properties. It's going to be structured differently. You're going to use different products. You're going to use different banks. There's no right or wrong. It just depends on what someone wants to do and what someone wants to achieve. I feel that we just figure out a little bit more in terms of what people want to achieve. And the other thing too is some people will come to a mortgage broker actually not really knowing what they want. So actually peeling the onion, finding out what their real goals are, I think is what sets us different.
Okay. And are most of your clients investors?
Most of them, yeah.
Okay.
Yeah.
So do you reckon it helps that they are dealing with someone who's also an investor? And
Yeah, 100%.
Because a lot of mortgage brokers aren't, right?
Yeah.
They don't invest in property. They might not have even done a property transaction.
Yeah.
So I reckon it's probably pretty important.
And I'm pretty honest. If someone comes to me and wants to get a home and it's like a first homeowner or someone that just want to get the lowest rate and pay it off, I'm probably not the best mortgage broker for that.
Yeah.
Because I don't get that sense of satisfaction by finding a rate that's the lowest. Whereas if I can help them build a property portfolio, maybe do things with equity pools, extraction, and helping them progress forward, that's what I get the satisfaction from. But that's also what I did personally. Yep.
So I want to talk about these additional 6 properties that you purchased over the last few years. But before we get there, while we're talking about mortgage broking, finance at the moment, how hard is it?
It's definitely getting harder with the Royal Commission.
It's getting harder, or it is hard, or is it going to get harder than what it is right now?
For a little bit of time there, it actually got a little bit easier before a lot of the Royal Commission came on. Why I say that is you would remember that above 80%, a lot of the investment loans had to be principal and interest.
Yeah.
CBA recently came back into the market and they allow interest only above 80%. So in terms of that, I feel that the investment lending was actually becoming a little bit easier. And then also the 10% cap on the investment lending is being removed. The full effects of that hasn't come in just yet, but I think that banks now will chase for investment lending a little bit harder. But with the Royal Commission and everything going on, banks are really looking at budgets, what people are spending a lot closer. So that portion of it is definitely making things a little bit harder than it was before.
And the clients that you work with who are investors, are they sort of have multiple properties normally?
Yeah, so multiple properties, or ones that are just starting out, but looking to build multiple properties. So they might have had experienced the Sydney boom, built up some equity, and they've listened to your podcast or read other forums around property investing, go, hey, actually, we want to build a portfolio for the future.
Yeah.
So they're the types of clients that I've been working with.
And what sort of tactics are you using as a mortgage broker to help people navigate these tighter lending requirements?
I think a lot of it comes down to the structure and also the banks that they use along the way. At the moment, banks, particularly the majors, they're quite difficult to borrow from. But that's not to say that all banks fit into that category. So which banks you use at which step of the way is very important. Other things that we do is we do a lot of valuation shopping between the majors and the variations that you can get on the valuation.
Valuation shopping. Can you explain that?
Okay, so it's like, say for instance, a property, you're looking to pull equity from it. instead of just going to one lender and getting a valuation for it, you might go to 3-4 different lenders. And depending on the valuation that comes back, a mixture between a full valuation, so someone going through and visiting the property, maybe it's a curbside, so someone driving past, a valuer driving past, or just a desktop, but maybe using a combination of those to see what kind of valuation you can get on the property. And you can actually get quite a big variance between those different methods. So helping extract a little bit more equity at the start, and then also using the right lenders along the way to then help them build that property
Isn't
portfolio.
it like 3-4 times more work for you because you do 3-4 more times
It is.
applications? Doesn't that look negative on your credit score if you've applied for finance across a whole bunch of different
So
lenders?
all of those we do upfront. We
Okay.
never submit an application before we actually know what the property value is.
Okay.
So all those valuations.
So you pay for the valuation before...
Exactly.
Okay.
Yeah, and then we all wear those costs. So, depending on if it's an upfront desktop or upfront full valuation, we'll get all of that. We'll then have 5 or 6 valuations that we'll then kind of assess. If they're all very similar, then we base it on the product, based on the rate and kind of the structure that you can use with that lender.
Yep.
And then we go down that path in terms of, okay, now this is the best product for you.
Okay, so that's a fair point that you shouldn't be doing applications all over the joint.
100%, yeah. And I know on the last show I spoke around credit hits and stuff like that.
Yeah.
That's really important. If you were just going to buy one property, having a couple of credit hits isn't going to be so important. But if you're building a property portfolio, multiple properties, on top of that, you're going to have equity pools, so more credit hits, then your credit profile becomes so important. So very important to do those up front.
So how else can you keep a really good credit score, credit sort of history, so it doesn't make lenders nervous?
I would say it's making sure that when you go for that application, you've done as much homework as you can, that it will be a pass. Because what the lender will do is once the application comes through, they'll look through the credit hits, and if they can see the loans match up to the credit hits, then you've got a good explanation for it. But in instances where you might have 10 different credit hits, but you can see they've only got one loan, then that might be like, what happened to all those credit hits? Did you get declined, or you went and actually got the loan but you didn't declare it? So it's a lot of it is around making sure that when you do an application, you've got all the information in place and you've got a good chance to pass.
Okay, so you want to be as clean as possible.
Exactly,
That's a good
yeah.
idea.
And then if there has been applications that you didn't go through, and then also make a note of that up front. As long as you're honest and open with the lenders, it's much better for you to tell them than for them to find out. Then they start to tear the application apart.
While we're still on this, what do you think about people holding big credit card limits? Is that a negative thing in this current market?
With credit cards, a lot of it comes down to their servicing. So banks, one kind of misconception that I have with some clients is they'll pay it off at the end of the month. And a lot of people do pay them off. And they're like, well, my balance is zero. The banks actually don't look at the balance, but at the limit. So a lot of the banks will take 3% of your limit. So if the credit card's say $10,000, then your monthly commitment is around $300 per month. So in those instances, when that affects your borrowing capacity, I've had many conversations with clients in terms of reducing credit cards to the point that we can get the loan to through.
Okay. And that's something you can play with then. If a lender comes back to you saying, oh, you don't quite meet the serviceability requirements, you can get rid of that. Or, a lot of people have car loans and this sort of stuff as well, right? And
That's right.
Which can hold back investors.
Yeah. And then the other things that we see, particularly with younger investors, is HEX. Now, I hate paying out HEX because you're not paying much of an interest on it, if any. But the thing with HEX is you might only owe $10,000 to $15,000 on HEX.
Yeah.
But HEX, the repayment is based on your salary. So if you have a $10,000 HEX debt, but you're on, say, 70, 80K, then the repayment is really, really high. So in a lot of those instances, it's actually better to pay out HEX, and that will improve your borrowing capacity by quite a bit.
Okay, so if you're a young investor and you wanted to start getting into property investment, pay your HEX debt off before you even think about it?
Oh, I mean...
No, but
Yeah,
it's a big serviceability piece, right?
definitely.
Yeah.
I mean, maybe not for the first purchase where you're not affected by servicing, but as you to continue to grow, then there'll come a point where those things like credit cards, car loans, HEX debt will definitely need to be paid out before you can start to progress.
And while we're still talking about what you do as a mortgage broker, the type of people you're dealing with, are they all shapes and sizes, or are you getting a lot of younger borrowers coming through looking to invest in property?
Yeah, like when I speak to people, they think that maybe younger people or people that of like an Asian background, but it's actually a wide mix. We just recently did some stuff for someone that was in their early 50s, and we work with people that are in their early 20s. So it's a wide spectrum across all ethnic groups, across all family makeups. I guess it also just shows that property investing kind of goes across the Australian demographic. Everyone is quite interested in it.
Cool. And What was your original job before you quit it?
It was actually in marketing.
You're in marketing.
I was in market research, yeah.
Okay.
Yeah.
That's right. I remember the chat now. So long ago, right?
Yeah, it was 2 years.
Long
Yeah.
time.
And I had to actually listen to the podcast to remember what we spoke about. So, yeah.
Yeah, that's right. And you punted that. Or did you leave that and then go straight into mortgage broking?
Yeah, I went straight into mortgage broking because I was doing part-time mortgage broking when I was still in my corporate role.
That's right.
Yeah.
So how did you go? Because you probably needed 2 years of financials before you could borrow money.
That's right. So literally for 2 years, I just sat on
Didn't
my
do anything.
hands.
Okay,
Yeah.
so is the question, as a mortgage broker, you're a small to medium business owner?
Yep.
You're self-employed?
Yep.
Which makes it a bit harder again to
Yep,
get finance.
definitely.
A lot of people who are self-employed run a lot of expenses through their business, so their business shows a loss, and they find it really, really hard to get finance as a result of it. You probably see a lot of this, right?
Yeah, 100%.
And I think there's a real misconception that you could use a small business as a vehicle to try and minimise your tax by running expenses through it, but it's a very narrow-minded way to go about
That's right.
wealth creation because
100%.
So you see a lot of that. So
Yep.
having been a mortgage broker now for a couple of years, you're able to show
Yep.
profit in that business, and
Yep.
therefore a bank is comfortable to give you finance.
Yeah.
Because I was worrying about that gap. You know, you've added 6 properties to your portfolio.
That's right.
So
Yeah.
so the bank's happy to give you money.
Oh, 100%. And that's
Yeah.
why for 2 years, I just sat on my hands. Like I didn't do anything and just worked very, very hard at growing the business, focusing on the business, and then getting it to a stage where once I had 2 years worth of tax returns, then I could borrow again and show the banks that I could afford to repay those loans.
So what was the first property when you were back in the game?
So the first one was actually a renovator.
Okay.
It was a renovator in Logan.
So that's probably 15, is it? Would be?
Okay, so I bought 14 and 15 in those years just with cash.
Okay.
So I didn't take loans out on them.
Okay. Oh, really? What? You just had a
Yeah,
spare couple $100 grand lying around?
Yeah.
Yeah. Okay. 1450 was cash.
Cash, yep.
Okay. All right. There you go.
Yeah.
What did you get?
So they were both deceased estates, like bank mortgagee type of deals. So one was in Logan Central for
Yep.
245,000.
Okay. So you just drew down equity, or you just said,
I mean, I had a little bit of equity before then, and I also had cash built up from the
okay,
business.
all
Yep.
right, okay, cool, all right,
And then
245.
yep, 245, and another cheaper in Woodridge for 220.
Townhouses.
No, they were houses. So one
Okay.
was a 3-bedroom house, and another was a 2-bedroom house.
Okay, cool. So that's 14, 15. So probably number 16.
16 was a renovator in Marsden for 267,000
Marsden in
Logan.
Logan.
Yep.
Yep. All right. Probably 17.
So 17 was when I kind of took a little bit of a different approach because I had quite decent servicing at that point, and I was looking through my property portfolio and I needed things that I could generate more equity with. So I started targeting 4,000 square meter blocks,
Okay.
and I bought a 4,000 square meter in Kingston, again in Logan. And that was
4,000 in Kingston.
4,000 square meters, and they don't come up a lot,
No.
Particularly in Kingston.
That's a big block. That's
oh,
like,
it's
normal
huge, yeah.
blocks there. There's big blocks in Kingston still, sort of 700, 800 sometimes, but
That's right.
4,000 is massive.
4,000 is pretty rare. So I can get about 6 to 7 blocks out of that one.
Okay.
The block next door has been split already, and that one was a purchase price of 750.
Okay. All right, we'll get back to that, but property 18.
Property 18, it was another one. So it was another 4,000 square meter block. That was in Logan Lee
Okay. How much?
for 830.
830. Okay. Property 19.
That one, again, it was in Marsden,
Okay.
and it was a property that was on 900 square meters, and that was 315.
Okay. 315. And the last one? Mentioned you just settled this, right?
Yep.
Yeah.
And then that one was another renovator. It was around about 270,000.
So this stuff in like Marsden and Logan and whatnot, it sort of sounds like good sort of, meat and potatoes type of properties.
That's
But what interests me are these 2 properties you've purchased in Kingston and in Logan Lee, 4,000 square metres. So you're essentially land banking.
That's right.
Okay.
Yep.
So what have you got? So there's 4,000 on one title?
Yes.
Is that right?
Yes.
So there's one property on each of these?
That's right. Yep.
So are they sort of semi-rural or they're just sort of...
No, they're completely residential. All the blocks around that have been built up. The one in Kingston, the one next door, they've already been split.
Okay.
And the vacant land that they're selling at for each of the blocks, around about 500 to 600 square meters, that vacant land's selling for 250.
Okay.
Yeah.
And how many are they getting out of it?
So that one, I think they got 6 out of that one. Yeah.
It's okay. All right. So what's the game plan with these?
At the moment, I'm just going to hold them.
Yeah.
Yeah. Kind of crunching the numbers with the DA costs, and then also all the kind of the construction to it in terms of just splitting up the blocks. I will turn a little bit of a profit, but I don't think it's enough to spend the time and energy in doing it. I think at the moment, focus on what I'm good at doing and then start to accumulate more properties and then just hold them for the future.
Okay.
When Brisbane really starts to take off, then yeah, I'll probably realize those. So maybe in 5 or 10 years time, we'll see.
Hence the reason why it's called land banking.
Yeah.
But I imagine your yields on that are pretty poor.
Oh, terrible.
Yeah.
So the first one, 750, only rents at 370 per week.
Okay.
Yeah.
So it's costing you a bit. What's your whole portfolio looking like? Is it positive or negative?
Yeah, so the property portfolio is probably positive about 40, 50K.
Okay.
Yeah, so I've definitely added in terms of properties that don't yield as well. Traditionally before that, they were all cash flow positive stuff, so around about 6.5%, 7% rental return.
So do you think if you just wait for this stuff in Logan, these Kingston and Logan Lee properties at 4,000 square metres, that some developer will come and just go, hey, here's some money, nick off?
Or I'll probably do it myself.
Yeah.
I think they're straightforward enough to do. In terms of all the blocks next door, they've all been done, so all the DAs, everything in place. So I don't think it'll be too difficult to do
People
myself.
putting townhouses on it, or they're just like actually splitting up, they're putting houses on it?
Put 7 blocks. A lot of them are doing the dual homes or
Okay.
just the standard 422.
So what would you do? Just put a cul-de-sac up the middle and then split it out that way?
That's right.
Is that what you do?
Yeah.
Okay.
Yeah.
Would you keep them all if you did it?
Maybe
Like to?
5 or 10 years time, I
Yeah.
would. I can't see why not. Yeah. Yeah.
What was the genesis of that particular strategy? Was it a bit of a light bulb moment? You went, oh,
It
hang
was
on,
when
yeah.
I crunched the numbers, because if you're buying a set and forget for like 250, 300,000, for $400,000 more, you're getting almost 6 to 7 times the land. And the fact that I could hold it and I've got the serviceability down to hold the portfolio almost made it a no-brainer. So at the moment, those prices are still, I feel, quite affordable for the amount of land that you get. But the only problem is they don't come up a lot. In the whole time that I've been looking at that market, it's only been about 2 or 3 and I bought 2 of them. So they're quite rare.
Do you think you overpaid?
I think for the second one, I overpaid. For the first one, I thought I got a good price. The second one, I kind of gave them what they wanted. But I think when you're playing in that ballpark, and in terms of the longer end spectrum, I'm looking at 5 or 10 years. If I overpay 20K for a 4,000 square meter block, in 10 years time, it's not going to matter too
And
much.
you make a good point there, and I think a lot of people get caught up in it, whether it's trying to save 0.3% on a home loan or 20K to miss the opportunity of holding on to 4,000 square metres in Logan Lee. You got to think bigger picture sometimes rather than the immediate. And if you can afford it, I guess it's okay.
But if it was, say, for instance, a renovator that comes around every couple of weeks, and there's so many of those around the Logan area, I definitely wouldn't overpay for that stock. But this type of product, I'm a little bit more okay with it.
Do you know who you're competing with on those? Was there much interest?
I know there was a builder because he contacted me afterwards.
Okay.
But the only reason why I got it, I did a lot of DD around it and I've got good contacts with agents in the area. So I knew that it was a very safe block. And also on both sides, it had been done already. But the main reason why I got it through was I did a cash offer. I had no conditions on it.
Okay.
And I know he had a DD clause because we caught up afterwards and he kind of shared his offer. So I think that's why I got it. The 750, I just acted really quickly and I had a good relationship with that agent there. So that's how we got that one.
What's the zoning in those areas?
Residential, and it's just the standard one, like 600 square meter block zoning. Just
So you happy with them?
Yeah, definitely. Like if more of these pop up, like definitely get them.
So on that basis, are you ready to go again, or are you happy to sit it out for a while?
No, we'll keep going. If there's a deal out there, happy to buy it. Yeah.
And you're still paying with cash money, or you actually
we have the equity now.
Yeah.
So I went through, and actually the 2 that I bought with cash, I'm actually in that process of pulling that equity back out at the moment.
Okay.
So we've got a bit of equity sitting there, and if there's a good renovator, or if there's a good, 4,000 square meter, or the other thing I'm actually just started recently researching is a completely new ball game is actually commercial property.
Yeah, okay.
And I know a lot of people, after they've done the set and forget, they do a little bit of renovation, then they get into maybe dabbling in subdivisions development.
Yeah.
I think commercial is also a good transition from that. So that's something that I want to have a look into.
Yeah, we're looking at it as well. Just from a yield perspective, it's pretty good, right?
Definitely.
It's pretty good.
Yeah.
So remind me where, and we don't need to go through all of them, but where are all your sort of properties 1 to 14?
Okay. So 1 was the one that we spoke about, was off the plan in Epping.
That's right. Yeah, yeah.
It was a terrible mistake over a night of poker.
Yep.
Yeah. So that was the first one.
So they're all in sort of Sydney-ish.
Yeah.
area.
And the second one's in Macquarie Park. And that's the one that really kind of set everything off, because that one's in the road going into Macquarie Shopping Centre, where now there's like high rises going up, and we've got like a low set unit there, and we're being offered by developers in terms of double the market price to pay it out. So now we're just kind of waiting for the
How many
right
in the
buyer.
block?
How many in the block? I know there's 80 owners in that complex.
Okay.
And it was actually on the financial review that if it does go through, it will be the biggest collective sale that Sydney has had.
Are you on the strata?
Strata, no.
No.
But at the moment, we'll just wait and see.
Okay, cool.
My gut feel is it won't happen this cycle. I think it's gone. Like in terms of the developing and also where the market is at, I don't think it will happen this cycle. But let's see in 5 or 10 years' time. So I think that one's going to be a little bit longer to realize.
Yeah.
Then I started doing renovations in Newcastle. One was a Coffs Harbour purchase. And then so I had 5 in New South Wales. And then after that, the remaining 15 are in Queensland.
Okay.
Yeah.
In Brizzy?
In Brizzy and all of them in Logan.
Okay.
Yeah. So
You're heavy in Logan.
yeah, I know. And I get asked this a lot. I'm not pro Logan in any way. And if you ask me, say for instance, we went back 2 years and I came back on this show and you said, Michael, you're still buying Logan, I probably would have said, I hope I'm not. Because in 2 years' time, I would have hoped that Logan market would have moved. But today, you're still buying very similar prices to what it was in 2015, 2016, especially with the APRA pullback.
Yeah.
I find Logan hasn't really taken off. In saying that, it just really depends on the numbers. I was looking very heavily in Geelong, but when I got all my finances together, my 2 years tax return, the market just absolutely took off.
Geelong's gone mad.
I know, ridiculous. And even just recently, like 2 weeks ago, I pulled it up again. Properties that were 310, 320 before just a couple of months, they're like 340, 350. And the rent is still 270, 280. So the numbers are starting not to make sense. So if I got my act together about 6, maybe 9 months ago, I definitely would have picked up some in Geelong, but now I feel the numbers don't work. And at the moment, I'm looking in Logan, also have one eye in the Moreton Bay Council.
Okay.
But because of my connections and also kind of my dealings with a lot of my property managers in the area, it's just a little bit, I tend to find better deals in Logan. And I think ultimately with property investing, not so much the area, but the deal itself.
Matt, they should give you the key to the city of Logan. You've got so much property out there.
I mean, I definitely pay a lot of council rates, that's for sure.
So when's it going to go though? You know, like we got a fair bit up in Brizzy after buying in Sydney, follow the market up there. And it's like everyone's sitting around waiting for this property cycle to start kicking in the gear. When's it going to happen?
I've got no idea. When I was, started buying in 2014, now in 2018, you would have hoped that it would have done a little bit more. I did actually recently pull like a bunch of numbers. So what I did was I looked at all my purchase prices and I did bank valuations across the whole Logan properties. And the equity had actually gone up from the value today to the purchase price by 600,000.
Okay.
At the time I did, it would have been about 12 or 13 properties.
Is that across the whole portfolio?
Yeah, no.
What's that a percentage?
I can't.
Yeah.
But this was just the Logan purchases. And the
Okay.
thing that I wanted to illustrate was that you could do well, but in Logan in particular, because the market hasn't moved, you need to make money on the way in. And that's why if you don't know the market well, also using buyer's agent help. Because say, for instance, you buy in Sydney and Melbourne, the market would have done a lot of this thing for you. But if you're buying in markets where it's been quite stagnant, you really need to make money on the way in.
And irrespective of how markets are moving, you should always try and make money on the way in, right?
Oh, definitely.
Make your money then.
Yeah. I think with the Logan stock, the only thing that gives me a little bit of comfort is it pays for itself. So it's not hemorrhaging money from my back pocket. So if it doesn't go up this year or next year and you hold it for the next couple of years, look, I hope that next time I come on the show that Logan's moved.
Yeah, okay. Well, so do I. I think the rest of Australian investors are waiting for it to kick in. But, the problem is that you've got this paradigm of Sydney from 2012 to 2016, where it went absolutely gangbusters.
Yep.
And people are expecting the same thing to happen up in Brisbane, which is not going to happen.
No.
Hobart's gone nuts, but, it's from a pretty low base and it's probably just catching up where it should be. But anyway, we'll watch and wait and see, Michael, to see how it goes. But sounds like you're enjoying it.
No, it's good fun, yeah.
Yeah.
Yep. So I think keep learning. I think the next little phase is around the commercials. If there's a good deal, we'll make it work and then continue helping people from the mortgage broking base. So
do you live and breathe property?
Yeah, definitely. Yeah. So talk about it in, outside of work, just in terms of...
Is it the first thing you think about when you wake up and the last thing you think about when you go to bed?
I mean, there are other hobbies outside of property investing, like touch football, and I love keeping like marine fish and corals and that kind of stuff. So that's like my other big time.
So you're like
kind
a fish nerd?
Yeah, a fish nerd. Like
you got to get a truck out the front and pipe in salt water into your tank.
Yeah. We actually do that.
It's really cool. I like marine fish, but there's so much work though.
Oh yeah, actually afterwards I'll show you some of the coral photos on my phone. So yeah.
What's your biggest tank?
So my tank's 600 litres and I've got a side frag tank that we cut up all the corals, and that's a 300 litre system.
A
frag tank, yeah.
I just know Nemo lives in those sort of things.
That's right.
Anyway, good morning. Anything to finish with? Give us a word of wisdom for. I'm going to say you're a sophisticated investor because it's a big portfolio. How are you going to go from 20 to 40 properties?
I think a lot of it would just come down to servicing and also the equity. Like a piece of advice would be in property investing, I feel is actually quite straightforward and a lot of people try to overcomplicate it. There's only two resources that you use in property investing. One is your borrowing capacity, how much the banks are willing to lend to you. And the other is how much savings, how much equity that you have. And those two resources are never unequal. One's always more than the other. So if you can figure out which one is your limiting resource, then spend all your time and energy targeting that. So I'll give you an example. If your servicing is limited, you're finding it hard to borrow from the banks, then buy in areas with good or better rental returns. So maybe Logan, or buy properties with a granny flat. That way that will boost up your servicing, allow you to pull out potential equity and then move forward. But if you're someone that's starting out and you're very young and you don't have a lot of equity to play with, but you've got good servicing and not much debt, then buy properties that generate equity. So maybe a renovator, buy in areas that have a little bit more better capital growth potential. So for that client, I would say maybe buy in Moreton Bay as opposed to Logan because the short-term outlook could be a little bit better. So I think the key for investors trying to grow their portfolio is focus on whichever resource is limiting, whether it's equity or whether it's servicing.
Nice one. Thanks, mate.
Cool.
So I can't believe it was 2 years still. It's a long time, but all right. Anyway, in 2020, May 2020.
Yeah, 2020,
get back
May
in, Michael,
2020.
and let's hope that Logan's moved. Anyway, watch this space. It should do. Something should happen.
Yeah,
you know?
fingers crossed.
So the experts are telling us. Anyway, remember to check out smartpropertyinvestment.com.au. Go and check out the story, the podcast, and there's a whole bunch of articles we did with Michael 2 years ago. The exact date was the 10th of May, 2016. It'll be on the website or whatever app you use to listen to these podcasts. See if he sounds any different. He doesn't sound any more jaded or distant about property. He seems to be hungrier, which is good to see. You know, it's a lifestyle property, really.
It is, yeah. And then after a while, it just becomes like a game almost. It's just fun. Yeah.
It's cool. Any questions for Michael? If you want to ask about his portfolio, I'm sure you'll be happy to do it. You can go through us and the team here, editor at smartpropertyinvestment.com.au. We'll be able to hook you up and connect you in. If you like social media and that's how you like getting your information, so you're the first to know what's going on in property investment, just search Smart Property HQ, or you can subscribe to our morning market intelligence, smartpropertyinvestment.com.au/subscribe. We'll be back again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.